Today's show is sponsored by Cloud Zero. For software-driven companies focused on growing margins, Cloud Zero is the only cloud cost intelligence platform that puts engineering in control by connecting technical decisions to business results. By analyzing cloud services like AWS and Snowflake, Cloud Zero provides real-time cost insights that help you maximize margins. Engineering teams can answer critical questions like, who are my most expensive customers? How much does this specific feature cost our business? What's the cost impact of re-architecting this application? With cost anomaly alerts via Slack, product-specific data views, and granular engineering context that makes it easy to investigate any cost, Cloud Zero is your complete cloud cost intelligence platform, connecting the dots between high-level trends and individual line items. Join companies like Drift, Rapid7, and SeatGeek by visiting cloudzero.com/cloudcast to get started today. That's cloudzero.com/cloudcast.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We're coming to you live from the massive Cloudcast studios here in Raleigh, North Carolina. Welcome to the first show of 2022. We hope everyone was able to unplug and get a little rest over the holiday break. Now, if you are a new listener within the last 12 months and haven't been with us for the beginning of a year yet, let me do a quick introduction, as our format will change just slightly for the next few shows. Every January, we take a few trends Brian and I think will be important in the coming months, and we go find experts. These shows will be less about specific products and technologies and more about macro trends in the industry for 2022. We call them our look ahead shows. We will resume our normal show format in a few weeks. With that out of the way, let's jump into Cloud News of the Week. For our first item, we have the always awesome Cloud at Judgment Substack. In case you are new to Cloud at Judgment, pull up the show notes right now, head on over to the link and subscribe. Cloud at Judgment does a great analysis of everything SaaS. For this week's article, we wanted to highlight the look back in Q3 in public cloud software. This was published right before the new year. And as always with Cloud at Judgment articles, this is very long, very detailed analysis of the winners and losers and the evaluation criteria used. The big winners aren't surprising here, Datadog and Snowflake. For both companies, they see high growth, great customer retention, and of course, great forward-looking revenue patterns. As I mentioned, the article is long, but it is a must-read for anyone interested in SaaS. I personally find the articles not just informative about the companies, but also educational into the frameworks, into how a VC thinks about valuations in the SaaS space. So definitely worth a read and definitely go check that out. For our second item, we have an insight into the state of the employment in our industry. If you have been following along with Cloud News recently, this shouldn't be a surprise. We've covered similar trends, similar patterns recently, but I wanted to highlight this one as well. George Oros has a great Twitter thread we'll link to on the state of hiring of senior versus junior tech workers. And this is an aspect we really haven't covered before. And there actually is turning out to be a polarizing divide that has been developing and is kind of coming to a head. And let me explain. For senior roles, demand is surging, and this leads to significant increases in offers. While junior positions, they're getting harder and harder to find. Now, why would this be? George points to a number of different reasons. COVID was a trigger in some ways and a little bit of almost like the gasoline on the fire, something that was simmering and has now been brought out and brought to attention. As mentioned by George, there are 6 trends kind of all hitting at the same time. George points to digital transformation across all industries, the exploding capital markets. At the same time, there's a drought in senior folks. So something else there is location doesn't matter as much as it used to. There isn't this need to be in the valley like there used to be as companies are adjusting to post-COVID work styles. And the adjustment upwards in salaries is something we have seen for a while. And George thinks will continue, but I admit I hadn't seen that entry-level positions becoming harder and harder to find. And so his analysis of the dichotomy there between senior and junior level positions is definitely something to think about as we move into 2022. For our third and final topic, we have a blog from the AWS Enterprise Strategy team. Now, if you aren't familiar with the Enterprise Strategy team, they meet with executives at their customers and help them with their future strategy. The article this week is a look back at 2021 and has some valuable trends that are worth highlighting and talking about. It's a great look into what are on the minds of execs across the world and across verticals and industries as well. The team took every blog from 2021 and broke them into themes: financial and business value, environmental and social, strategy, AI and ML, execution, which, by the way, most articles were in the execution bucket, and security. If this is interesting, head on over and give it a read. And it's a great jumping off point to do some reading and is a great summary for 2021. With that, I'll close out Cloud News for this week. Coming up after the break, we have our first look ahead with good friend of the show, Aneel, talking about venture capital markets and funding in 2022. Today's show is sponsored by JumpCloud, introducing the JumpCloud Directory platform, the directory reimagined for the modern world. JumpCloud changes the way IT administrators manage their organizations by providing a comprehensive and flexible cloud directory platform. From one pane of glass, manage user identities and resource access, secure Mac, Windows, and Linux devices, and get a full view of your environment. Try JumpCloud for free today at jumpcloud.com and help your organization move to a modern, secure hybrid work model.
Today's show is sponsored by Datadog, a cloud monitoring platform built by engineers for engineers, enabling full-stack observability for modern applications. Datadog integrates seamlessly to gather metrics and events from more than 450 technologies, including cloud providers, databases, and web servers. Easily identify slow-running queries, error rate bottlenecks, and move fast with built-in dashboards, algorithmic alerts, and end-to-end request tracing and log management. Datadog helps engineering teams troubleshoot and collaborate together in one place to enhance performance and prevent downtime. Start a free trial today, and Datadog will send you a free t-shirt. Just visit datadog.com/cloudcast to get started. That's datadog.com/cloudcast. And we're back. And Aaron, we are kicking off 2022. How was your holiday, man?
Good. And it's interesting too. You can probably hear it in the background, but something that hasn't changed, as we roll into 2022 is background noises and uncontrolled things. You heard fire engines, there's dogs, there's helicopters, but we're going to power through today.
Absolutely. Well, we always like to start off the year with these sort of look ahead shows, right? A little bigger context shows. And we always say the best place to start in this industry is to sort of follow the money. So we thought, well, let's go right to the source. Let's talk to some of the VC folks who are, putting money into the market. And, it's great to have a good friend of the show, longtime friend of the show, Aneel Lakhani, who is now venture partner at Crane Venture Capital. Aneel, welcome back to the show, man. It's good to hear from you.
Thank you so much for having me.
It's you are now. So you've been on the show a few times. We've worked together. We've known you for a very, very long time. You've been on the industry side of things. You've worked for a lot of very cool companies. You've been an investor. You're now a VC. Give folks just a little bit about, kind of how you've evolved the last 4 or 5 years and what eventually got you to doing VC full time.
Yeah, sure. So the last startup I was at, I ran marketing. I left that startup and basically took a little time off and then was freelance for a bit, stepped in as head of marketing a couple of times at different companies. And then I started working with dedicated portfolios. So I was working with one or another VC's startups to help them with marketing challenges as they grew. And that led to becoming interested in investing full time, which led to joining Crane as an investor.
Yeah, good stuff. So fill us in for those folks who, only know venture capital from the headlines. So and so company gets big round of funding, or you see pictures of VCs running around at events in puffy vests and stuff. Like, give me a week in the life, for example, day in the life of what venture capital is doing these days, especially nowadays, since we're going to get into this. Like, it feels like things are kind of crazy all over the place. But just give folks a sense of who you're interacting with, how you're collecting information to make decisions, all those sort of things that you're doing day to day.
Yeah, sure. So the average day is full of meetings, which is honestly not that much different than any of my previous jobs. Spending a lot of time on Zoom or Google Meet, or sometimes on Microsoft Teams, even though I dislike Teams. And all we're doing is talking to people who have started companies, figuring out whether or not those are good ideas from our perspective, whether or not they serve a real need out there in the world, whether or not these people are the right people to do that, whether or not a company is going to be successful, which is as much art as science, and then talking to a bunch of people who are not ourselves to go figure out whether our theories are true. So I spend as much time going through all the people I've ever worked with or known who can give me an honest read on whether or not something's like a good idea, or if I'm right that there's a market need for some kind of product, or if I'm right that some person working in some role, like a data scientist, really needs a new way of experiment tracking or whatever. And validating our ideas so that we can have some confidence when we go into an investment. And that is the majority of time. That's hours and hours and hours every day, just talking to people, basically doing that. And then you spend a little bit of time actually doing deals.
So Aneel, what I feel like, and especially this is evolved over the last 5 years, but then, Brian and I have talked in the past, it seems like the funding models have changed and how much money is flowing. And it seems like it used to be like A round, B round, C round, and then IPO as quickly as you can. Now it's like, oh, we've got a G round and an H round, and it's all big, rounds and super big valuations. And so, it seems like there's a lot more money flowing into the startups, first of all, but a lot more even early on, like crazy big A rounds, for instance, right? And so there almost seems to be like a quote unquote home run mentality kind of happening of these go big or go home. Is that really happening, or is this just what catches the headlines?
Oh,
okay,
no, that's really happening. There is, generally speaking, not just in VC, there is just a lot of money flowing around looking for places to park itself to make a return. So if that's true everywhere else, it's also true in VC. In VC, you also have a few other things happening. One is very, very large funds that did not typically invest in early stage companies are investing in early stage companies, and they're willing to spend more money at that stage. You also have the rise of individual investors who are not firms. They're just a person who has hundreds of millions of dollars to spend. And you run out of bigger private companies, bigger startups to spend money on, because there's generally the later stage you go, the less competitors there are, because a bunch fall out. So if you're looking for places to stick your money, you keep going earlier and earlier, and you keep competing for deals, which keeps pushing up prices. And this is a self-reinforcing loop right now.
Yeah, and is it kind of? I mean, is it that because is it more people looking for places to put money, or do you feel like it's these sort of giant rounds are happening early because people are like, whatever this thing is, it needs a lot of fuel, if you will, to go compete against a Google or a Tesla or a whatever. I mean, does it feel like sort of the David and Goliath needs a really big rock on day one kind of mentality, or is that maybe not it so much?
I think it's a little of both. I really do believe, however, that it is more a function of a lot of money looking for places to go rather than a function of wanting to compete. Because arguably, the barrier to competition keeps going down over time, or at least that's what we say. That's what we all believe. That's what the whole industry is predicated on. Although clearly it is hard to compete with big incumbents like Google. But on the flip side, there should be 20 sales forces. There aren't 20 sales forces. Why aren't there 20 sales forces? Mostly because people find it boring to build a sales force. But if someone came along and built a sales force, I don't think it would take that much money. It's just not a lot of people want to do it.
Right.
Interesting. Okay. So Aneel, let's kind of go back then to some of your personal things. How do you go about creating your investment thesis, like we were talking about earlier, other than millions of Zoom calls, right? Do you have like a future horizon you think about? Is it certain tech sectors? Is it founder personalities? Is it all of the above?
Well, I'm at a firm, so there's the firm's thesis and what the firm invests in, and then within that, there's what my interests are, and within that framework where I like to spend my time and efforts. I'm a little ADD in these things because I'm interested in a lot of things, so I tend to be all over the place. But I do have some expertise, so I tend to be deeper on the places where I have a background and I've worked stuff associated with analytics or with time series, stuff like that. And then everything else is also interesting to me. So as a firm, we specialize in B2B software, things that are enterprisey or things that are tools for people who build things with software. So developer-facing tools, open source tools, data science and data engineering-facing tools, things like that. So that's a general range of stuff we invest in. Some of it is vertical, like we do a lot of investing in machine learning applications in vertical spaces like logistics and supply chain. And some of it is purely horizontal, like an investment we recently publicized called Cerbos, which is basically a permissions system for internal app permissions to control, who has access to what under what conditions, both internal users and external users.
Yeah, I'm curious. When you guys get involved with a company, obviously you can get involved really early or later rounds and so forth. Like, how having been sort of on both sides of the fence, right? You've been at some early stage startups that have grown, and now you've been on the investment side. Like, how does that tend to work? Like when there's one kind of primary investor, they're trying to help you. They're allowing the founders to do certain things. What happens when there's a bunch of them, and you've either got sort of competing interest, or like what does the startup company expect from their investors once there's 5 that are sort of leading the C round or D round?
Yeah, well, I'll state it from our stage because we are an early stage investor. So we do pre-seed and seed. We'll put in a little money at Series A or Series B, but we're usually done by the time growth rounds come around. Insofar as we're not a significant portion of the cap table, we're not a significant holder of equity, and we're not the biggest player on the board by far. But even at the earlier stages, this is a dynamic of it's, I would say, not much different than managing an executive staff, right? You've got a bunch of people on the board. They all generally want the startup to succeed because if the startup succeeds, they succeed. Sure. Usually the only time there's contention is, one, if the startup is not succeeding for some reason, and people have different ideas about why that is or different ways they think they're going to solve that problem. Or two, if the startup is succeeding extremely well and there's jockeying about who's going to get how much allocation in the next round, or who's going to get more equity, or who's going to be able to put in more money. Those are usually the conditions under which there are disagreements, and the board needs to be managed. But it is, I don't think it's materially different than managing when you're in a later stage and you've got a bunch of execs in a room, managing that dynamic. There are people, sometimes they have competing interests, and you have to balance them out. And as founders, part of your job is to run your board and not let your board run you.
Yeah, that makes sense, man. Manage it up as opposed to letting them tell you what to do. Interesting. Very interesting.
And Aneel, let me ask you this then as well. You mentioned earlier, Crane is more early stage. What defines, or what are kind of the differences between early stage and later stage? When is it just more of like, okay, this is the mentality and the staff and what they want to get involved in, and they want to get in these stages, and
Yeah, it can be.
what do they look for, right?
It can be hard to tell what is and isn't early stage anymore.
True.
When I think of early stage, I think of, one, how much investment have you raised to date? So there's early stage from the perspective of Crane is typically going to be your first institutional check. Or I think of where you are in the life cycle of your first product, whatever that is. When we invest, typically you don't have a product in market, or you do have a product in market, but you've not begun to monetize it. So you've got a freemium version and the free version's out, and you don't have a paid version yet. Or all you have is a prototype, and you're like basically at MVP. So that's typically when we invest. So for us, that is what constitutes early stage. Although there are people who go much further at early stage, where they've raised no money and yet they've got a V1 out there with 50,000 users, right? And there are other people who early stage is just some slides or a Notion document, and no team, no code, not even an architecture.
So yeah, let me ask you a question. So, you've been on sort of multiple sides of this, right? You've worked at companies who've, been at various stages. They could be early stage or mid stage. Like, how do you think about sort of the balance between people come to you, they're looking for funding, and in some cases they're going to be totally new, right? Totally new idea. They're going to try and create their own market, or they've leapfrogged something in technology, versus somebody comes to you and maybe they go, hey, we're a better, I don't know, just as an example, we're a better observability mousetrap, and we're not even observability anymore. We're beyond. Like, how do you balance between being like, I want to go after this thing which is sort of unknown, but I really think it is sort of the future, and just being like, boy, there's a really big known market there, and the incumbents have become kind of fat and lazy, and maybe that's where to go. Like, do you think about it that way, or is that a balance you have to find?
I am 100% okay with both of those things.
Okay.
To be honest, the way I think about it is, some of it is portfolio construction. We've got X many companies we can invest in for this fund. They can't all be solving the same exact problem for the same exact people. So we need some diversification there. So if I've got a bet in like observability, I'm not going to make another 5 bets in observability. That's just not going to work, because I've got competing interests within the portfolio and the fund.
Right.
So some of it is that. Some of it is that, it is good to have a few complete, we might be 10 years too early kind of moonshots, but we think we're directionally right. And maybe this company and this team can survive long enough for the market to mature such that they are right, because they're the first one there with the dominant position. So you have to have some like that. And then the rest of the time, what I want is someone who deeply understands a problem space because they've lived it, who's passionate about solving the problem, and they care more about solving the problem than they care about being right. By which I mean, if 50% of what they had in their head as the right way to solve the problem actually solves the problem, and 50% doesn't, they'll throw out the 50% that doesn't and fill it in with stuff that does. So they're primarily oriented around solving the problem, not primarily oriented around making a point in the world.
Yeah.
And then is that problem sufficient that, one, people would pay for it to get solved? Is it enough of a problem? And two, is that market that those people represent, is that, best case scenario, is it an unbounded market, right? Is there no end to the future growth of that market? Which in some cases is actually true. That's true actually in a lot of places. I mean, penetration of commerce online versus offline, it's still minuscule compared to what's possible. So building the next great e-commerce platform is serving an unbounded market. That's basically true. And any bet in that space, if you think it's a good one, is worth taking. Now, we don't invest in e-commerce, so that's not pertinent to Crane, but there are plenty of places in the B2B world where also there are things like that, where you're not inventing something from scratch, but there is a market that's underserved or unserved, and it's effectively unbounded from where we stand.
Yeah, it's interesting you call out the ones who have sort of lived in this space, or who are like passionate about solving the problem, whether or not it necessarily becomes. I think we learned that lesson early on. I think we were one of the first interviews we did with Mitchell Hashimoto, who's started HashiCorp, was sort of his journey of like, I started this, I was doing this job and I couldn't do certain things, and I just built the tool that was gonna make my day job my day job easier. And then like he always would come back to us. He'd come back a year later, and he'd go, I just think this is the right way to do it. And it was never about like, we're going to dominate the market. It was just like, I think this is the right way to build tools, and the market has sort of come around to his way of thinking. But it's interesting that you look for those same sort of things. It just sort of jumped out at us as being like, oh, that just makes a lot of sense.
Yeah, what I've found, and what works for us anyway, is that people who are oriented that way tend to be more resilient to, the ups and downs of trying to build something and facing a lot of rejection all the time, and persisting and having things not work and falling down when a big customer comes on board. All of those things, which are the natural ups and downs of trying to build a company. It's hard to be resilient to that if you aren't driven by something that is sort of external to you.
Yeah, absolutely.
Aneel, let me ask you this then. So how involved do you get with the companies? How involved do you even want to be? Because that might be a different answer. And how much is like founder led versus VC led?
Yeah,
as well.
Well, Crane has a specific model that I fit well within, which is that we're fairly hands-on, and we, insofar as founders want us there with them, we build the foundations of the company with them. So, I'm on a board. I've led a bunch of investments. I'm basically extended executive staff for those folks. I get pinged all the time, day and night, on multiple platforms, and I basically behave as if I work at that company. Not full time, because that would be crazy, but more or less that's I respond. We figure stuff out together. We hop on a call. I'll talk through like deals with big customers that they're working to figure out how to like structure a contract, which is like a weird thing for someone on a board or who's a VC to get involved in. However, I can do that work, and they need the work done, and so I help them with that work. Or things like, how do we figure out how to structure the go-to-market team? How do we lay out our analyst relations plan? Like all these things, which are over time will become things that operators within those companies do. When your company is 8 people, 5 people, 20 people, you might not have those people. And Crane has that expertise in-house, because we specialize in providing help with go-to-market stuff like sales and marketing and customer success and PR and comms. We have people on staff with deep experience in all those areas, and we help with that stuff. So Crane is fairly deep and fairly hands-on. I don't know that that's typical. I don't really know what is typical anymore, because there are so many things now. There's so many different formats of what is a venture capital firm, whether it's one person or a bunch of people, whether it's like 2 individuals with a rolling fund or a company with 10 billion AUM that has hundreds of people. The models vary quite a bit.
Yeah. I want to ask you sort of one last question. We bounced around a bunch. Obviously, we'd love to know what the crystal ball looks like for the future, but we don't want to put you on the spot for that. But for anybody that follows you on Twitter, they know that, at some time in the morning, at Aneel is going to send out a tweet of some lovely cup of coffee somewhere. What I assume, having known you in the past, you're always reading. That might be, at a coffee shop. It might be at your house or whatever. What are some of the things that have sort of macro level, piqued your interest, both on the investing side, but also on the personal interest side? Because like you said, you tend to be interested in a whole lot of things, from the whole spectrum. Like I suspect at some point you do very, very well on Jeopardy. But what kind of stuff are you reading along with those coffee cups each month?
On something like Jeopardy, it would be so hit or miss. We would hit some topic and I would totally destroy it, and then we'd hit something else and I would be abjectly ignorant and get nothing because it's so random.
Right.
I am so random. So what I'll say is there are things where what I'm interested in, what Crane's interested, overlap directly. So things like I have a pretty strong belief that what is happening in what's called a creator economy out there in the world of consumer stuff and social media and whatnot, that same thing is going to happen with software. And we're going to think less and less of software as, or maybe not think less of, but we'll have a new branch of thinking in software instead of it being an industrial activity, which is what it is today. There will be a creator version of it where there will be a lot of people who make a lot of software who are supported with similar kinds of tools that are afforded to musicians, for instance, where you could have a manager, you could have a company that advances you the money to produce a record and then markets it for you and advertises it for you and takes a big chunk of the profits. Like there are any number of models that exist in the consumer world that I think will begin entering the software world because a lot of people are beginning to, and in the future will approach software as artists or as creators who are producing something, who are creating something themselves, who don't necessarily want to go out and build a company. And a lot of people will want to go out and build a company, but regardless what they'll want to, there will be people who what they want to do full time is make software and be creative with it and somehow find a way to make a living with it. And we don't have enough ways for that to be true today. It can be actually quite hard for that to be true if you're an individual software maker or a small team. So that's one thing where I have a belief about the future that overlaps with Crane, and Crane has a belief about that future. And then there are other things that are just me where I think the mid-market is completely underserved by software as a service. There's just not nearly enough software designed for mid-market concerns, and it's a completely untapped market because it's hard to get investors excited about mid-market software companies. And that's a thing that people are solving by having different kinds of investment firms that are happy to like invest in mid-market companies and take a fixed return instead of trying to get a VC kind of equity slice that turns into a return to fund dynamic. So there are people trying to solve that problem because they also believe that. And then I also think that all the like everything it takes to build a software as a service company, there's hundreds of things that go into it at scale. All of those things all of those things should be products. I don't understand why every company rebuilds all the same plumbing over and over again every single time. A lot of that stuff can be pulled out and turned into a service or a product, and it will be over time.
Yeah. It's funny you mentioned that because it's related to a day job conversation, but I had literally that exact conversation this week of why the hell is everyone in our industry rebuilding these platforms for SaaS services? But anyway, yeah, I completely agree. That's a fantastic note to kind of end this on without a doubt.
There's one more thing. I can't let it end there because it annoys me to talk about it, but I can't not talk about it because I would be remiss. There's the world of blockchain and cryptocurrencies.
Oh no, we're going to go on for 3 more hours.
Oh no.
No, we have to.
Get it out there. Get it off your chest.
We have to.
Throw it out there, Aneel. Go ahead.
So, as an old timer now, which is to say, having been coincident growing up with the rise of the internet, a lot of the crypto and blockchain world, it seems profoundly boring to me because we're just watching people rebuild the same stuff and relearn the same lessons again in a new format, which is fine. That's how evolution works. Great. But there is something there, and it's something that has nothing to do with the underlying technology. The something there is that clearly there is demand for people who don't have access to a stable currency, who don't live in a politically stable environment, who can't rely on the foundations of, the structure in which they live politically, economically, socially, from a business perspective, need a place that delivers to them some of that. And where that's coming from today is from the world of blockchains and cryptocurrencies. I don't think necessarily that's the best way for that to transpire, but nevertheless, clearly there is demand.
Yeah. Do you see it somewhat analogous to, I don't know, 15 years ago, 20 years ago, when people would talk about how, whether it was in Asia or Africa, and it was like these emerging places are just going to jump to mobile because they're not going to build out legacy infrastructure to do landlines. And so even though it was, significantly limited technology or whatever, that was readily available to them, and it didn't have that burden. I mean, is there an analogy, sort of a comparison there, or is that maybe not the right way to think about it?
Oh, I think there is, but I personally think about it differently, and now I'm totally out on a limb by myself. I think the thing that people don't have that they're leapfrogging to is a new governance model or a new business model. And it just so happens that the only way to have those new models and to play around with them and to use them and to see if they work or not and to have access to them today is via all the stuff happening in the world of Web3. And that I believe in. The idea that some portion of economic activity is going to look more like community-owned co-ops rather than centrally controlled corporations where you've got a stack of people with different influence based on the amount of equity and percentage of ownership they have over the company. Is that possible? Yeah, I think that's possible. And although the world of Web3 is the thing that's making it possible today, it's not the tech that matters. It's the fact that what we're enabling is experimentation with different forms of social contracts and different forms of doing business and different forms of making decisions that involve more people.
It's good stuff, man. I think, like you mentioned, we could go on this for a while, but no, it's good stuff. You always do a really, really good job of sort of connecting dots. So we like the chance to pick your brain a little bit. I'm going to wrap it up there, just because I know you're a busy man. You've got many Zoom calls, as we mentioned, to take, and
always
it's good to get your insight, Aneel. If somebody either wants to pick your brain, wants to give you some good information, or they're a company looking to work with a really cool VC fund, what's the best way to get in touch with you or to get in touch with the folks like at Crane?
Yeah, there are two best ways. One is at Aneel, Aneel on Twitter, or Aneel at crane.vc.
Very cool. Aaron, we're kicking off the year in good standing. It's great to have Aneel back on the show. It's good to sort of follow the money. And folks, I think we're going to wrap that up there. As always, thanks for listening. Thanks for kicking off 2022 with us. Wow, we're that far ahead. And thanks for giving us feedback in all the ways that you listen to the show. Thanks for telling a friend about the show and helping us grow. And with that, we're going to wrap up, and we'll talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.